Welcome back to The Deep Dive. We're the show that aims to cut through the noise, get right to the heart of influential ideas, and really pull out the insights you need. Today, we're tackling a giant. Benjamin Graham's The Intelligent Investor, first published way back in 1949. People call it the Bible of value investing, but, the big question is obvious. 1949. How does something that old still resonate so powerfully today?
It's honestly quite remarkable and, yeah, a bit humbling how relevant a text from the mid-20th century remains. Because it's not about tips or hot stocks, it's about, well, foundational principles, a mindset really that helps you navigate all the market craziness. Our goal here is to equip you with that core wisdom, to show you why Graham's ideas are arguably more crucial now than ever, especially with, how volatile things can get.
Okay, so let's dive right in where Graham himself starts. His core philosophy and that really famous distinction he makes, investor versus, well, the other guy. Seems simple on the surface, but how do we really tell them apart, and why does it matter so much?
Well, Graham's whole approach is incredibly disciplined, rational, almost feels countercultural today, doesn't it? He famously said, investing is most intelligent when it is most businesslike. That sums it up pretty well. For him, you're one of two things. You're an investor, patient, analytical, focused on the long haul, the actual value of the business, or you're a speculator, thinking short-term, driven by emotion, maybe hype. Basically, you're betting on price changes, often pretty recklessly. But the key isn't just defining them, it's his warning. You must never delude yourself into thinking that you're investing when you're speculating.
Ah,
It's powerful. It demands real honesty about what you're actually doing in the market.
that honesty part is tough. The market is constantly tempting you, right?
Right.
Pulling you towards speculation. So if rule one is don't speculate, what are the actual tools Graham provides to help us stay disciplined? For me, the big one has to be margin of safety. Sounds straightforward, maybe too simple. But what is it really, and why is it considered like the absolute cornerstone?
You're right, it is the cornerstone. Margin of safety isn't just a nice idea, it's your ultimate defense. It means you always aim to buy a security for significantly less than its intrinsic value. What you calculate it's truly worth. Think of it like building a safety net or a buffer.
A buffer.
Exactly. This gap, this margin, protects you, not just if the market tanks, but also if you messed up your valuation a bit, which, let's be honest, happens. Its real strength is safeguarding your initial capital. It gives you that crucial room for error. It sounds easy, but the discipline it takes to actually wait for that price that goes against every urge in today's always-on market.
That waiting part. Yeah, that's the challenge, especially when everything seems to be going crazy up or down. And speaking of crazy, you can't really discuss Graham without mentioning his legendary Mr. Market metaphor. Can you sort of paint a picture of this character? And crucially, how are we supposed to interact with him?
Right, Mr. Market. Imagine you have a business partner. Let's call him Mr. Market. And he's, well, manic depressive, might be putting it mildly. Some days he's euphoric, bursting through your door, offering to buy your share of the business for a ridiculous price, just totally over the top. Then the next day, he's plunged into despair, desperate, willing to sell you his share for peanuts, rock-bottom prices. And the thing is, he shows up every single day with these offers, often completely detached from the business's actual performance. Totally irrational. The key takeaway isn't just his mood swings, though. It's how incredibly hard it is to ignore him when everyone else is freaking out or getting excited based on his latest offer.
Yeah, the herd mentality.
Exactly. The intelligent investor's job is to use Mr. Market's irrationality. Buy from him when he's depressed and selling cheap, maybe sell to him when he's wildly optimistic. But never, ever let his mood dictate your own view of the business's value. And today, with phones buzzing 204/7, social media shouting, Mr. Market isn't just knocking, he's basically living in your pocket, screaming constantly. The challenge is immense.
That makes perfect sense. The constant noise just amplifies his moods. And his crazy offers really underscore why we need to understand intrinsic value. How does Graham tell us to figure out what a company is really worth, separate from Mr. Market's daily drama? Is that difficult?
Intrinsic value is exactly that, the genuine underlying worth of the business itself. It's based on fundamentals, things like earnings power, dividends, assets, future prospects, not the number blinking on the screen. Now, figuring it out, yeah, that's the work. It requires real analysis, digging into financial statements, understanding the business model, projecting future earnings realistically.
So not just glancing at a stock chart.
Definitely not. It's the complete opposite of just betting on the chart or listening to some talking head. It's business analysis applied to stocks.
Graham also knew that not everyone invests the same way, even if they're being intelligent. He breaks investors down further, right, into defensive and enterprising.
Mm,
What's the difference there, and how would you know which camp you fall into?
that's a great point. He recognized different temperaments and, frankly, different amounts of time and effort people are willing to
Yeah.
put in. The defensive investor, you call them the passive investor, prioritizes safety and minimizing errors and effort. They focus on broad diversification, maybe index funds, or a portfolio of really stable, financially strong companies. Low risk, consistent, pretty hands-off.
Okay, that sounds like a common approach.
It is. Then you have the enterprising investor or the active investor. This person is willing and able to put in significant extra time and research. They're actively looking for specific stocks that seem undervalued by the market, maybe special situations the average person overlooks. It requires more skill, more analysis, more effort.
Or risk, too, potentially.
Potentially, yes, if done poorly.
Right.
But the idea is the extra effort leads to finding better opportunities. Both paths are valid under Graham's umbrella, but they demand different things from the investor.
So let's tie these threads together. We have the investor versus speculator mindset, the margin of safety buffer, dealing with Mr. Market, focusing on intrinsic value, and these two investor types. It feels like it all comes back to handling market fluctuations. Graham had that famous quote, right? About the investor's worst enemy.
And is likely to be himself.
Yes. Powerful, isn't it? He fundamentally believed that our own emotions, primarily fear and greed, do far more damage to our investment returns than any external market event. So his core advice on fluctuations is resist the urge to react emotionally. Don't panic sell in a downturn. Don't chase stocks wildly in a bull market. If you truly understand the intrinsic value of what you own, and you understand Mr. Market is often irrational, you can actually use volatility.
Use it. How?
Well, a big market dip for the prepared, intelligent investor isn't a disaster. It's Mr. Market offering bargains. It becomes a buying opportunity. It requires immense emotional control, self-discipline. That's maybe the hardest part of his whole philosophy to actually implement. Definitely sounds like it. And okay, when it came to the actual picking of stocks, particularly for that defensive investor, Graham was pretty strict, wasn't he? He had specific criteria. He wasn't just looking for anything cheap. What kind of company passed muster?
Oh, incredibly strict, especially for the defensive portfolio. He was all about capital preservation first. He looked for large, prominent companies with a long history of continuous dividend payments, strong financial condition, low debt relative to equity, and crucially, a long record of profitability. Like positive earnings for at least the last 10 years. Sometimes he suggested 20.
Wow, 10 or 20 years.
Yep. And specific valuation limits. He often talked about price to earnings ratios below, say, 15 and price to book ratios below 1.5. Sometimes he combined them. Essentially, he wanted stable, proven, boring businesses bought at a very reasonable price. Nothing flashy, nothing speculative, just solid value that could endure tough times.
It really is striking how much of that core thinking still feels right, even though, 1949 feels like ancient history in market terms. So let's tackle that head on, its relevance today. How does a book from the post-war era speak to us now, with algorithms, crypto, meme stocks, all of it? What helps bridge that 70-plus year gap?
That's the million-dollar question, isn't it? And honestly, a huge part of the answer for modern readers lies in the commentary added in later editions, particularly by Jason Zweig. Zweig does a masterful job. He takes Graham's core principles and applies them chapter by chapter to much more recent market events.
Ah, so he provides context.
Exactly. He'll discuss, say, the dot-com bubble. How Graham's ideas about intrinsic value and speculation perfectly explained why paying astronomical prices for companies with zero earnings was, well, doomed. It was pure Mr. Market mania. Or he'll talk about the 2008 financial crisis, showing how margin of safety was crucial for those who weathered the storm. This commentary really brings Graham's timeless wisdom into the 21st century, making it feel immediate and applicable, even with all the new complexities. And that points to the book's enduring strengths. It's grounded in human behavior, fear, greed, herd mentality, which hasn't changed one bit. It provides this bedrock of rational, disciplined thinking. It warns against fads and hype, which are perhaps louder now than ever before. And it speaks to everyone from the absolute beginner needing guidance to the seasoned pro needing a reminder of first principles.
Okay, but fairness requires us to look at the other side, too. No book is perfect, especially one this old. What are its weaknesses? Where might it feel dated or maybe just really difficult for someone picking it up today?
That's fair. There are definitely parts that show their age. Some of Graham's very specific stock screening methods, like the precise ratios he used, or demanding things like, a 20-year unbroken dividend record.
Yeah, that sounds tough to find today.
It can be. Markets are faster now, company life cycles can be shorter, information is everywhere. Applying his exact 1949 screens might be overly restrictive or just impractical today.
Uh,
Also, let's be honest, parts of the book can be quite dense,
yeah.
dry even. If you're brand new to investing terminology, it requires real effort.
Not exactly a beach read.
Not exactly. No, it demands focus and patience from the reader, much like the investing style it preaches. So that can be a hurdle for some.
Okay, so acknowledging its incredible strengths, but also its, let's say, vintage aspects. Who really benefits most from reading The Intelligent Investor today? Who should absolutely have this on their shelf?
Honestly, pretty much anyone who is serious about building wealth over the long term through the stock market. For beginners, it's crucial. It provides that foundational mindset, helps you avoid those really common, costly emotional mistakes right from the start. It sets you on the right path. For intermediate investors, maybe you've been investing for a few years. It helps refine your strategy, deepens your understanding of fundamental analysis, and builds conviction in a sensible, long-term approach. It grounds you. And even for professionals, maybe especially for professionals, it's a powerful reminder of the philosophical underpinnings, the importance of rationality and temperament, things easily forgotten in the day-to-day market noise. It's a touchstone.
So a kind of universal guide against market folly.
You could definitely say that. It's an antidote to speculation and emotional investing, no matter your experience level.
What an incredible exploration, The Intelligent Investor. It really earns its reputation, doesn't it? Even with some dated bits, it clearly remains one of the most vital investing books out there. It's not just about what to do, but how to think. That mindset shift, being disciplined, patient, realistic, that seems to be the core legacy.
Absolutely. And maybe here's a final thought to consider, something that takes Graham's wisdom even beyond investing. Think about his core message. Control your emotions. Focus on real underlying value, not just surface appearances or hype. Practice patience. Ignore the crowd's irrational swings. How might applying that same disciplined, patient, value-focused approach, waiting for the right opportunity, assessing true worth, tuning out the noise, benefit other major decisions in your life, outside of just your portfolio?
Hmm. That's a really interesting way to frame it, applying Graham's logic beyond finance. A deep dive for another time, perhaps. Thank you so much for joining us on this journey through The Intelligent Investor. We hope these insights are valuable for your own path, financial or otherwise. We'll catch you on the next deep dive.